Have you ever woken up, looked at the market forecast, and just thought, what on earth happened? One day everything looks fine, and the next it's forecasting a total meltdown. Well, today we're diving deep into a perfect storm, a mix of global conflict, economic shocks, and a corporate bombshell that's threatening a massive 500-point nosedive for the Indian market. Let's get right into it and break down how this whole thing came together.
But hang on, before we jump in, just the usual quick reminder. This whole breakdown is for educational purposes. It is absolutely not financial advice, so please make sure you do your own research before making any decisions, all right? Let's go. So this is the number that's got everybody talking. A 500-point gap down. That's the forecast for the Nifty opening. So how did we get here? Well, it wasn't just one thing. It was a series of events, both overseas and right here at home, that created this massive wave of negativity. Let's unpack it, piece by piece. Okay, so this whole thing really started thousands of miles away. We're going to look at the international dominoes that tipped over first, setting the stage for the crisis that landed on our doorstep. You know what's really crazy here is just how fast this all happened. I mean, look at this timeline. Yesterday morning, things were looking pretty good. There was an oil deal between Iraq and the Kurds, and crude oil prices dropped to $101 a barrel. The market loves that. But then, boom. Right around our market close, Israel attacks a huge gas field in Iran. And then overnight, Iran hits back, firing missiles that strike Qatar and a U.S. airbase in the UAE. The result? Brent crude shoots up from 101 all the way to $110 a barrel. That is a massive, massive swing in less than a day. So, as if a potential war over oil wasn't bad enough, that U.S. decided to drop its own economic bombshell. The producer price index, you can think of it as wholesale inflation, was expected to be pretty tame, around 0.3%. Instead, it came in at a whopping 0.7%. That's more than double what everyone was expecting. And that just sent shockwaves everywhere, basically screaming that inflation is nowhere near being under control. And you can see the chain reaction right here. That scary inflation number, plus the Fed chairman coming out and saying he has huge concerns about oil prices. Well, it completely sank the U.S. markets. The Dow, the S&P, the NASDAQ, all deep in the red. But check out the VIX. That's the fear index. It jumped 12% to over 25. That tells you that real anxiety, real fear just shot up across the market. All right, so you've got global chaos, you've got war fears, you've got inflation shocks, and just when you think it can't get any worse, a massive crisis starts brewing right here at home, and it's centered on one of our biggest, most important banks. This wasn't just adding fuel to the fire, this was like dropping a bomb on it. Whoa, just look at that number for a second. Negative 7.5%. That's how much HDFC Bank's ADR, that's the version of its stock that trades in the U.S., crashed overnight. When a banking giant like that falls that hard, that fast, it's a huge, flashing red light for the entire Indian market. So what in the world could cause that? This is the reason. The bank's part-time chairman, Atanu Chakraborty, just quit, out of nowhere. And in his resignation letter, he left this cryptic and honestly deeply worrying message. He said certain things were happening at the bank that just didn't align with his personal values and ethics. You know, he didn't give any details, and that's the terrifying part. A statement like that from the chairman is exactly the kind of thing that makes investors panic. Okay, so with all this terrible news swirling around, how are the big players, the so-called smart money, setting themselves up? Let's peel back the layers and look at the actual data to see who's betting on what. So, in the regular cash market, it's a story we've seen before. The foreign institutional investors, the FIIs, were selling heavily. They pulled out 2,700 crores. But on the other side, you have our domestic institutions, the DIIs, who stepped up and bought 3,250 crores worth. It's that classic tug of war, foreign money flowing out, domestic money trying to hold the line. Now, this is where things get really fascinating. Look at the derivatives market. Do you see the disconnect? Retail investors, that's us, the clients, are actually net positive. We're betting the market is going to go up. But meanwhile, both the FIIs and the prop traders are positioned negatively. They're betting on a fall. And that is a huge red flag. When retail is on one side and all the big institutional money is on the other, well, historically, that can be a very dangerous place to be. The options data basically gives us a map of the current battlefield. You see that big pile of put options at 23,000? That's acting like a major floor, a big psychological support level. On the other side, you've got resistance building up around 23,800. And look at the put-call ratio. It's ticked up to 1.09. All that means is that traders are buying more puts, which is like buying insurance against a market drop. It's a clear signal that caution is growing. And this brings us to the ultimate showdown for any trader. It's the story the charts were telling us just yesterday versus the brutal, hard-hitting news we woke up to today. We're talking about two completely different, totally contradictory stories. So let's just hit the rewind button for a minute. Go back just 24 hours. Before the missiles, before the inflation shock, before the chairman resigned, what did the technical picture actually look like? What were the charts signaling? Honestly, the picture was beautiful. It was incredibly positive. The market had formed a bullish reversal pattern. It had just broken out of a downtrend. It closed above a really key technical level. Even the RSI, the momentum indicator, was flashing a buy signal. I mean, technically, everything was pointing up. The stage was literally set for a rally. And that leaves us with the million-dollar question, doesn't it? We had a chart that was practically screaming buy. But then we had this tidal wave of fundamental news that screamed crisis. So what wins? When the real world intervenes this violently, do all those pretty bullish patterns on a chart even matter? Do they even whisper? That's the ultimate dilemma.